We're excited about the great lineup of extraordinary speakers that are here. Hopefully you appreciate the messages that they've prepared, and that provides an opportunity for you for enhancing your professional skill set and your understanding of what cutting theme ideas are going on in accounting. So the schedule today is located in the app. We would encourage you to download that from the App Store, Partners in Business. And one of the great features about the app is that it does provide an opportunity for you to respond to the speakers through a survey. So we'd really appreciate the feedback that you would offer on the presentations. It helps us improve our programs and our offerings so that we can better tailor our conferences to meet your specific needs. Just a reminder, we will have lunch this afternoon. It begins at 12:05 in the TSC Ballroom, the Taggart Student Center, which is over in this direction. There will be signs out directing you in that way, and also the parking validations will be available at lunch. We'd like to thank our bronze sponsor for this conference, Becker CPA. Appreciate their support. If you'll join me in turning your cell phones on silent mode before we start, minimize the disruptions to the presentations. And to get started this morning, our first speaker will be introduced by one of our students, Jacob Fryer. So Jacob?
Hello, I'm Jacob Fryer. I'm a graduate student here at the university. Yesterday I had the pleasure of picking up Mr. Greg Anton from the airport and getting to know him a little bit. And I'm very excited today for his presentation. I actually was able to hear his presentation about 6 months ago at a conference in Denver. So you have a great thing ahead of you, and it's my pleasure to introduce Greg. Greg Anton is the chairman and CEO of Anton Collins Mitchell, a Colorado-based CPA firm. He served on the board of directors of the American Institute of Certified Public Accountants from 2006 to 2009 and 2010 to 2013, and served as the chairman of the board from 2011 to 2012. He's the recipient of the AICPA's 2015 Gold Medal Award for Distinguished Service, and is the founder of the AICPA's What's at Stake? The CPA Profession on Federal Fiscal Responsibility Initiative, which offers nonpartisan guidance on how the U.S. government's financial statements can be used for greater understanding of the nation's fiscal health. Please join me in welcoming Mr. Greg Anton.
Thanks, Jacob. What a great host, and what a great university. Awesome setting, right up against the mountains. I don't know why we're all here at 7:50 in the morning when we could be up there, but we'll do our best. And I see all my friends are in the front row again. How many people here have read the U.S. government's financial statements cover to cover? This is the typical response I get. And it's also the typical response I get when I'm speaking to members of Congress. And I'll tell you, I had never read the U.S. government's financial statements either. I didn't actually know they existed. How many people even knew they existed? Few. We know a budget exists, right? Because the budget's talked about in the newspaper every day. So the financial statements themselves, I didn't know they existed either. But I've been really active and involved with the standard setting process, with accounting standard setting and auditing standard setting. So I participated, or was asked to participate and chair a committee that evaluated the federal government's accounting standard setting process. What a great honor, huh? So I said, why not? I didn't know the financial statements existed. I didn't know the standards existed, but I'll do it. I'm familiar with the standard setting process. So chaired a committee, read 3 years, at that time, read 3 years worth of the financial statements, the U.S. government's financial statements, read all the standards, and I was appalled and frightened and scared each page that I turned in the financial statements. So I'm going to share with you some of what I learned in that process. And at the end, I'm going to share with you some of the things that we're doing as a profession to help members of Congress and citizens better understand what's there and how this financial information can be utilized to better manage the country's operations. So here we go. Maybe, here we go. Do I need to push? Maybe I didn't turn it. No, it's on. So, Jacob, my helper, my sponsor, the dude that introduced me and drove me from the airport, make the clicker work. If you could be Vanna White and just push the button when I say advance. It worked a minute ago. Probably. Don't ask my wife. I am often doing things I'm told not to do. So I can't even remember what the next slide is, but I have a faint memory. So I'm going to tell you what's there, and then we'll hope it's what pops up. So the budget. We've all heard about and we've all read about the budget in the newspaper, right? We hear about it constantly. All members of Congress understand the budget exists. Well, beginning in 1921, there was a law that was enacted that required the President of the United States to put forward a budget on an annual basis. Congress has to vote on that budget, and it's put forward on an annual basis. The budget's on a cash basis. It has nothing to do with financial reporting. It's the cash in. Does it work?
You're good to go.
Sweet. It's the cash in. Oh, look at this. It's the cash in and the cash out. Has nothing to do with financial reporting. It's a budget measured on a cash basis. The financial statements themselves utilize the FASAB standards, the Federal Accounting Standards Advisory Board standards. You've all, or those that are students, how many are students here? Way to get up so early. So, the students will all learn about the FASB standards. You'll learn about international auditing standards. You'll learn about international financial reporting standards. You'll learn about GASB standards for state and local government. You'll never learn about the FASAB standards. And I don't think you're asked about it on the CPA exam. If you are, you'll at least know what it is now. But the FASAB standards, nobody knows what they are. I didn't know what they were. And I've been practicing in public accounting for 25 years before I was asked to get involved in this. The FASAB standards are completely different than FASB and GASB standards and IFRS standards. And I'll share with you some of those most significant differences. But be aware that there's a whole separate set of standards that exist for the federal financial statements. And this will give you a perspective of the difference between the cash budget and the FASAB. They're really on a modified accrual basis, not full accrual, but a modified accrual. The red bar is the budget deficit on a cash basis, cash in, cash out. The white bar are the actual losses in the financial statements utilizing the FASAB reporting standards. Why are they greater? Because the FASAB standards are on a modified accrual basis and they accrue interest expense as an example. There's accruals for certain expenditures that are booked in the financial statements that aren't included in a cash basis budget. So the losses of the country are always greater than the actual budgeted losses that you hear about and the deficits that you hear about in the newspaper. These are the actual budget deficits. The Congressional Budget Office evaluates, reviews, and kind of keeps track of the spending and receipts. $483 billion in 2014, $435 billion in 2015. For the next projection, which they do projections and they update on an annual basis into the future, through 2025, the cash budget deficits are projected to be $7.6 trillion. That's just the cash that's going to leave the country greater than the cash that's going to come in. Has nothing to do with accruals, it's just on a cash basis. So I'm talking about trillions, and the rest of this talk is going to be trillions. How many zeros are in $1 trillion? Somebody said 9, somebody said 10. You're moving in the right direction. 12. You passed the test. 12 it is. But this is what I like to do. I like to put $1 trillion in the context of time, because I think we have a general understanding of what a million is. So 1,000,000 seconds is 11 and a half days. 1 billion seconds is 32 years. 1 trillion seconds is 32,000 years. Everything I'm going to be talking about now is in trillions. 32,000 years worth of seconds compared to in 1,000,000, 11 and a half days. That's the magnitude when we hear about trillions. The financial statements have a 9/30 year end. They're produced on an annual basis. Treasury produces the financial statements. GAO, the Government Accountability Office, audits them. The Secretary of the Treasury is appointed by the President of the United States. They're responsible for the financial statements. The balance sheet is included with the financial statement. I'm going to start with the income statement. The 9/30/2014 financial statements were issued last year in around February. The 2015 financial statements will probably come out sometime towards the end of Christmas. So these numbers are the most recent audited financial statements of the federal government. Revenue of $3 trillion, expenses of $3.8 trillion for that loss, the FASAB loss of $0.8 trillion. The revenues themselves, how they break down, this is really important to understand, because I'm going to come back when I talk about solutions at the end, how we deal with increasing revenue and reducing costs. This blue up here, that's all other revenue into the country. Excise tax on cigarettes, tobacco, alcohol, park service, park fees, inheritance taxes. This gray right here, in all the periods presented, the gray represents 3 to 9% of the total receipts. Those are corporate income tax receipts to the federal government. The white, payroll tax receipts and individual income taxes. So individual income taxes and payroll taxes fund this country. Corporate income taxes virtually do nothing. Expenses. When we hear about we have to fix entitlements to solve the problem on the expense side, these charts are right out of the U.S. government's financial statements. Social Security Administration, Department of Health and Human Services, 25 and 24%. Almost half the budget is basically entitlements. Department of Defense, 17%. The fastest growing line item in the budget and in the financial statements is interest. Why? Because every year we spend more money and we add to the budget deficit. It increases the liabilities, it increases the debt burden, and we just had the debt burden that was raised just recently, right? Each and every day the country is spending money, accumulating debt, and interest is at near zero rates, but this is all-time record highs for the amount of interest expense that we actually incur, and interest is going to continue to crowd out the rest of the budget. When I talk about solutions, remember this slide. The balance sheet, $3.1 trillion in assets, $20.1 trillion in liabilities, $17 trillion accumulated deficit. At the time, at 9/30/2014, this $20.1 trillion of liabilities, about $17.5 trillion were actually debt obligations, interest-bearing debt obligations. And just last week, you remember reading in the paper, the president signed into law, enacted a new debt ceiling that's going to last 2 years into the next president's election. So this is what was in the front page of the USA Today. The USA Today. National debt sees one-day record increase after debt limits suspended. The U.S. national debt shot up $339.1 billion yesterday, the largest daily increase in the national debt history, according to the Treasury Department. Why is that? Because they reached the $18.1 trillion debt ceiling, and they couldn't spend any more money and borrow any more money to spend, so they started trying to find, anybody have any cash in this drawer? Anybody have any surplus in this drawer? Where do we have surpluses? We'll spend that money, because we've hit the debt ceiling. We can't borrow any more money. We have to shut off the borrowing, and we got to figure out a way to pay our bills. And they projected how long they could do that for, and they said, we can do that till Friday, last Friday, and if we don't get this law enacted to extend the debt ceiling, we'll have to shut down the government again. Remember the government shut down a couple years ago? Well, that's what was in the paper today. $339.1 billion was added on Tuesday. So the actual interest-paying debt as of yesterday was $18.5 trillion. So now let's talk about what's not there. And this is actually the meat of what I want to talk about. It's not what I just talked about, because what I just talked about is in basic knowledge of economists that look at this and study this. It's in basic knowledge of those that are dealing with federal government issues. But here's what's not basic knowledge. The FASAB standards. The Social Insurance Trust that holds Social Security and Medicare is an unconsolidated entity. So all the liabilities of the Social Insurance Trust are not included in the $20.1 trillion. They're in a separate entity. All of the liabilities of the Federal Reserve, Fannie Mae, Freddie Mac, and 30-something other government-sponsored enterprises are not included in those liability numbers. They're off-balance sheet, unconsolidated entities in the FASAB standards. Beginning in 2017, government-sponsored enterprises are going to have to consolidate into the U.S. government's financial statements on a new standard. But the Statement of Social Insurance, the Social Insurance Trust, will not. So let me share with you what is in the Social Insurance Trust as a debt obligation. These are right out of the financial statements of the Social Insurance Trust. They do an actuarial analysis of the present value of the incoming tax receipts and the outgoing expenditures. It's basically the pension standard that's followed by commercial enterprises, by FASB standards. And they produce an actuarial calculation. 2009, $52 trillion is what that liability is, with no assets. 2010, it's $43 trillion. You see that $9 trillion decline? Beginning in 2010, those of you that are in practice, you know what a modified and an unmodified opinion is, right? A modified opinion is bad, an unmodified opinion is good. Beginning in 2010, GAO gave Treasury a modified opinion. 2011, 12, 13, and 14 modified opinion. GAO believes these numbers are short by about $10 trillion. Beginning in 2010. 2009, they got a clean audit opinion. Remember, Treasury produces the financial information. The President appoints the Secretary of the Treasury. GAO is an independent auditor. So here's the audit opinion. Readers are cautioned that amounts reported in 14, 13, 12, 11, and 10 may not fairly present in all material respects the financial condition and changes in financial condition of the federal government's social insurance programs. When I talk to members of Congress and I say, here's the financial statements, let me walk you through them so you can understand the financial statements. And then I have to explain to them that the numbers that they're looking at aren't good. Like, what type of audit is that? How can they issue a bad audit opinion? Why don't they just change the numbers? Auditors can't change the numbers. Auditors can just audit what's presented to them and then report on it. But that's what exists today, right now. Modified audit opinions, 2010 on the Social Insurance Trust. So what does it mean in aggregate? What does it mean in aggregate? The 20 trillion in liabilities that are on balance sheet, the 57 trillion off balance sheet as reported that we know are about 10 trillion short, but I'm going with what's in the financial statement for the 77 trillion. Those are really the true liabilities of the federal government with virtually no assets. And then we look at the net worth of every citizen in the country, and we accumulate those. The Treasury produces what's referred to as the Federal Funds and Flows Report on a quarterly basis that estimates the net worth of all the citizens in the country, the nonprofits and foundations. The net worth of all of us, $81 trillion. It's up a little bit, but so are the debt obligations. This information is all produced as of the audited balance sheet date. So what does that mean? It means that we're at a tipping point. It means that every asset that every citizen in the country has is encumbered by a liability that the federal government has, basically one-to-one. And it doesn't include any state, local, county, school district, fire district obligations. It's just federal obligations. How many people here think they have a net worth? Other than the students. Well, the good news is if we allocate the debt to every citizen based on their net worth, we have the same net worth as Warren Buffett, Mark Zuckerberg, and Bill Gates, because we're all at zero. But that's effectively where we are right now. That's the issue we have to deal with. How do we deal with it? Well, the simple answer is we have to increase revenue, reduce expenses, grow the economy, and do it for decades. That's the simple answer. In this on and off, in the on and off stuff, the timer on this thing went to 0. So now I'm really going to need you to tell me when I need to get off. But so in any event, increase revenue, decrease expenditures. I'm going to share with you what I think we need to do for revenue considerations to increase the revenue to our country. These are my thoughts. They're not the AICPA's. They're not any of my partners. And they're really not my spouse's or my wife's. So let me share with you what I think we need to do. And I believe these are nonpartisan recommendations. And the reason I think they're nonpartisan is half of you are going to hate what I have to say, and half of you are going to love what I have to say on opposite points, which to me means it's nonpartisan. So here we go. We have to flatten the tax base. When Mitt Romney gave his talk in 2007 that was recorded by an iPhone that said 47% of the citizens don't pay any federal income tax. That was true at the time. Last year was 45%. That's federal income tax. Some are paying state income tax. Everybody's paying sales tax because we all buy things. So and if they're working, they're paying payroll taxes. There's payroll tax receipts. But federal income tax, at that time, 47% paid none. Last year it was 45% paid none. Flattening the tax base means those that have the ability to pay something need to pay something. We need more people paying into the system. I like to live by the 80-20 rule. 80% generally can deal with 20% not paying in. And the 80-20 rule works in virtually every instance where 80% of your revenue comes from 20% of your customers. This one, I often get moans and groans. We have to increase the effective tax rate on high-earning individuals. And what do I mean by this? I don't mean that we need to raise the income tax rates on individuals. What I mean is we need real baseline alternative minimum tax where individuals that are earning significant amounts of money, $500,000 and above, $1 million and above, individuals that earn $1 million and above in our country, their average effective tax rate's about 23%. It's not high enough. There's a lot of those individuals that are paying close to 0. Everybody that's earning significant amounts of money, they have to pay in something. There's too many loopholes that allow 0 to be paid in. And we can't have it 0. We need a reasonable rate of income tax coming in on reasonable amounts of income. This one was talked about widely in the debate. Does anybody remember in a couple of the different plans that were talked about in the debate last week that was in Boulder, Colorado? What were some of the tax rates for corporations that were thrown out by some of the candidates? Does anybody remember? Somebody had 10 on a flat tax. Trump had 15, where they wanted to bring the corporate income tax rates to. Well, today, our corporate income tax rates between the federal government and the state, with a blended state average of about just over 4%, total just over 39%. We have the highest effective tax rate, the highest top marginal rate other than 2 countries in the world, Chad and the United Arab Emirates, then the United States. The worldwide average is just over 22%. So if states are going to collect on average 4%, take 22% less 4%, 18%. In order to be globally competitive, we have to reduce our corporate income tax rates to a level that are in line with the global averages. Why? If we don't, we'll continue to see tax structuring out of doing business in the country. What do I mean by tax structuring your way out of doing business in the country? You read about inversions in the newspaper all the time. It was just the most recent one with Pfizer, where Pfizer was looking at buying an international company, reincorporating internationally, and then reducing the U.S. income tax bill. That's what an inversion is all about. Companies tax structure their way out of doing business in the United States. Remember I said to remember that slide that showed only 7 to 9% of the corporate income tax revenue in total, of all the revenue received, 7 to 9% is from corporate income tax. It's not high enough. The amount that we're collecting is not high enough. And the reason we're not collecting what we should is because companies are structuring to pay taxes in other countries around the world at lower rates. And if we reduce our rates, it will motivate companies to pay taxes in the United States versus someplace else. So we have to bring our tax rates down to a globally competitive level. Let me share with you one other little tidbit of information. If we go back to 2001 and you look at all the public companies in the world, the end of 2001, and we compare the market capitalization of companies in the United States to companies in the rest of the world, 52% of the world's public companies by market capitalization at the end of 2001 were in the United States. At the end of last month, it was 37%. We've lost massive market share of global public companies as a result of, I think, two things. One, our regulatory environment compared to the world is not competitive, and our tax structure in our country is not competitive to the rest of the world. And we need to create global standards that make sense for the world in regulation, and we need to have competitive tax structures in our country to maintain and attract and retain companies into our country. The last one is the tax gap. The tax gap is the underreported and unreported income. The last time the IRS studied this, they determined it was about $450 billion. It's a lot of money. $450 billion on an annual basis of underreported and unreported tax. Why is it so large? Well, we have a paper-based, archaic system. You get a W-2 in the mail, you get tax filing information in the mail, and then somebody has to bring it if they don't know how to prepare a return. I can't prepare my own return. It's complicated. To bring it to somebody to prepare the return. If we had a system based on technology where the information was fed directly to the IRS receives that information, they basically pre-prepare a tax return for you, withhold the proper amounts of money, technology is going to reduce the tax gap. And in time, even the IRS will have modernized technology, but it's going to take some time to get there. Spending considerations. The first one. This was widely talked about in the debate. Some people said we needed to do something on entitlements, some said we didn't. Here's the reality on Social Security. When Franklin Delano Roosevelt signed into law the Social Security Act in 1935, they looked at the 1930 census and determined how long people lived. What do you think the average age was of people's life expectancy in 1930? 60. 65. 60 is really good because that's the blended average between men and women. Women, 62. Men, 58. And you got a benefit if you reach the age of 65. Social Security was intended to make payments to individuals that outlived life expectancy. How many people here think they're living past 65? That's the problem. We haven't indexed the benefit to life expectancy. There's some people here that are actually living proof that it can happen. You will live to 65. The first year the Social Security payments were made, in 1937, they paid out $1.2 million. $1.2 million. That's nothing, right? In seconds, it's 11 and a half days. Last year, they paid out over 1.3 trillion. So we don't have to change the age tomorrow, but we have to change the age over a reasonable period of time to give people an opportunity to plan for what they will and won't receive from Social Security to fix the problem. And it needs to be needs-based. Needs-based, what do I mean by that? Well, while Warren Buffett accumulated all of the wealth that he has, he did pay into Social Security. But while he paid into Social Security, the country ran up an $80 trillion debt obligation. So did he really pay in? Is the money really there for him? It was spent. It's gone. We have debt obligations. So if you don't need the money, should you get the money during the time period the country created all these losses? That's a debate. I'm not going to give an answer to that, but that's a debate that we're going to have to solve the financial crisis that we have in our country's financial position. Same thing with Medicare and Medicaid, and this is a moral issue, and I'm not here to debate a moral issue. Healthcare is a moral issue, but today, the commitments to provide healthcare to citizens in the country is greater than, the costs are greater than the economic ability for the country to provide what is promised. We have to change that. We have to reduce the cost of healthcare, and we have to identify what we're going to provide and what makes sense to provide. Because at the end of the day, all the young people that are here are going to pay for things that otherwise may or may not be paid for. Because to the extent that we continue to incur the debt's going to be coming out of your paychecks in the future. So we got to solve this problem. Pay down the debt before the interest rates rise. If the debt is at 18.5 trillion, every 1% increase in interest rates creates over $180 billion of additional expense. We only collect $3 trillion a year. 2% rise, 3% rise, 4% rise in interest rates, and it will happen. There are people here that remember the mortgage on their home at one time was 14%. Now they're 3%. In my lifetime, interest rates on mortgages were over 14%. Interest rates will go up. And as they go up, they're going to crowd out the rest of the budget. And what do you get for interest? Nothing. You get nothing. And what's going to happen? At some point in time, those that hold the debt of the United States are going to say, this is getting a little too risky. I want a bigger return for this. So if we don't start turning the table and reducing the debt, right now we're reducing the deficits. We're not losing as much money on an annual basis as we did. But we need to make money on an annual basis to pay off the debt, right? Last one, all government programs need to be sunset reviewed on a 5 to 10 year basis. There's programs that are designed to have a return on investment, like the R&D credit. And there's programs that are designed for mission and purpose. And they all need to be evaluated for whether the return is efficiently and effectively taking place, or the mission and purpose of the program is being executed on appropriately for the money that's being spent. We don't do that in the federal government today. At the state level, on average, 40% of the revenue that states receive comes from the federal government. On average, 40% of the revenue that states receive comes from the federal government. What's the first place the federal government looks to cut when it needs to cut spending? Say that again? State Medicaid payments, state-funded programs, because let the state deal with it. We got to deal with our issues at a federal level. Let the state deal with their problems. So higher education, I mean, you're sitting here at an incredible institution. This place is beautiful, man. You guys are lucky to be here. The cost of education, higher education, goes up and up and up and up and up. Why? Because federal funds that come into states are diminishing, and states are not able to capture federal dollars, the cost of education goes up, tuition goes up, and higher education is seeing the impact of this big time. So Utah is the only state I know that has done this, but they've actually produced, just recently, the Utah State Legislature produced a program where any citizen can go and play with this thing and interact with it. You can put in job creation, job losses. You can put in federal funding, reduction of federal funding. You can put in increasing personal income taxes, corporate income taxes at the state level to see what that does to the state budget. You can reduce the federal funding into the state to zero to see how much the state would have to fund if the federal government provided zero funds to the state. The model itself, you can Google Utah Federal Funds Risk Management Model, but that's the website that you can go to. I think it's amazing. States are getting on board with this is a problem. And the states that are ahead of it are putting together programs like this so they can help the state legislature and citizens better understand what they're having to deal with and how to manage through the problem. The last slide in my ask to you before I turn it over for responses and questions. I mentioned at the beginning of the program that I chaired this committee that evaluated the FASAB standards. Learned a lot in that process, and I met with our members from mainly Colorado of Congress and went through the financial statements with them, walked them through page by page. Here's what you need to understand. Here's where you have there's a modified opinion. This is what a modified opinion means. The numbers that you're looking at aren't actually the real numbers. Walk them through all this financial information. Then I started thinking, man, none of these people that I'm meeting with in Washington have any idea the financial statements exist. And they don't know what the implications are. So I said, maybe we should create a program that we're going to teach members of Congress what's in these financial statements. And we did that. That's what the What's at Stake program is. So these videos that you see here, there's 4 videos. There's a really bad actor in most of the videos, me. But the message is really pretty good. And each one of the videos is available at this website, aicpa.org/what's at stake. So my ask to you is, post this to your Twitter, post this to LinkedIn, post it to Facebook, make people aware of it. You can get access to the U.S. government's financial statements, the 2016 budget, and then most importantly, there's a report called the Citizen's Guide to the Financial Statements. It takes those hundreds of pages of financial statements and it boils it down to about 30 or 40 pages that's really actually easy to understand. Make people aware of it. Spread the word on the videos. What we did, there were CPAs from Utah, from Colorado, and every other state that took these videos and hand-delivered them to our members of Congress. We all met in Washington, D.C. We go every other year where we take a group of CPAs from across the country to meet with our members, House and Senate, and talk about critical issues that they need to be aware of from a CPA's perspective. And this is one of the critical issues that we brought to their attention. So the video series is utilized for that purpose, but they're also produced for citizens as well. My contact information's here, my email, LinkedIn, and Twitter. Feel free to connect with me, ask me questions about anything, anytime, on this topic or anything else accounting related. And with that, I'll open it up for observations, questions, and generally nobody wants to ask question number 1 or make observation number 1, so I always immediately go to question number 2. So we're going to question number 2 right there.
Your proposals seem reasonable and very much in line with what the Bowles-Simpson committee offered, and that went nowhere. How do we get past that?
So the point was the recommendations that I've made are similar and in line with the Simpson-Bowles Commission that met, bipartisan group met. I actually did a similar presentation to this last week with Al Simpson. And with a through a group called Fix the Debt. That's another thing you can do is you can go out to Fix the Debt. Another ask would be go out, look at the Fix the Debt website, look at their information. You can sign up and become a Fix the Debt supporter. But this is what, and from Al's perspective, why it didn't go anywhere. Not from my view, but from Senator Simpson's perspective. They had really good plans, they had really good information, they had a really good program, a really good idea. And some of what I said is some of what they said, and some of it's a little bit different, but it's in line with cut corporate taxes to increase the volume of revenue, bring companies back into the country to pay taxes here, and change and simplify the tax regime, and produce operating cash flow surpluses into the future. Not immediately, but into the future. His thought on that was they didn't have enough there wasn't enough political will, and the issue wasn't known widely enough by members of Congress or the president at the time. They knew it was a problem, but they didn't understand the magnitude of the problem. At that time, we had only had a couple of debt ceilings that were widely publicized. Now the debt ceiling comes about every year and everybody knows about it. The government shut down a year and a half ago. So they believe if it were instituted now that it would get traction. I think that too. But I don't think it's going to happen until we have the next president's cycle. There's too much big, meaty changes that need to happen here. And I believe there will be another Simpson-Bowles type commission that's appointed under the next president to deal with this issue in a bipartisan, nonpartisan way to solve the problem. I'm optimistic that that will happen. Tell me how much time I have. 10? Thank you. Please.
So you talk about how there's the $77 trillion in the total liabilities. So if we have budget surpluses of $1 trillion a year, it still takes 77 years to pay it all back. That seems like a long time. What are the chances that people would have stopped lending the U.S. government money before that time? What's the risk of that?
The point was the debt, $77 trillion. It would take $1 trillion a year in surplus to pay off all the debt. I'm not advocating to pay off all the debt. In any business, whether it's a commercial enterprise, a nonprofit, or a government, you've got to appropriately capitalize those organizations or entities. An appropriate capitalization is not $1 of debt for every dollar of assets. That's basically debt to equity ratio of 1 to 1. That's not appropriate capitalization for a country. Appropriate capitalization might be something in the 20 to 50% of total assets, the 20 to 50% level. The way that the economists look at this is what is the deficit on an annual basis as a percentage of GDP. In my opinion, that's the wrong way to look at it, because deficits accumulate and add up. If you have a deficit every year as a percentage of GDP, eventually those deficits add up to become a really big number, and they crowd out GDP. So when we hear about the deficits are coming down, they did go down. They went from about 480 billion down to 430 billion, and they're less than half of what they were in 2008, 9, and 10. But they're not down low enough. We're not going to have to do $1 trillion a year for 77 years. We're going to have to get them down to a reasonable level that can be maintained and create sustainability into the future. And your point, what happens if people say, I'm not going to lend money to the country. I'm just not going to do it. Well, then interest rates go way up. The same thing that's happening in Greece would happen, where Greece has to pay huge rates of interest to get investors to invest in their country because they don't believe they're going to get the money back. We can't let that happen here. Please.
So you said you're optimistic that we're going to see the change at some point. What's going to spark that in your opinion? Will it be a catastrophic event? Will it be a new presidential regime? What do you foresee as the most likely scenario where we'll see the change?
The point was, what's going to happen that creates the change? Will it be a catastrophic event or something else? I'm optimistic that the political will exist to deal with this issue. It's actually becoming relatively well known in Washington by the members of Congress, House and Senate, and as well as the economic advisors to the president. It's talked about in the debate. They even talked about, most of the people here, most of the students don't remember Ross Perot when he ran for president, but they talked about Ross Perot in the debate with all of his funny charts. Ross Perot predicted all this stuff. He had all his charts. When we had this meeting, when I did this presentation last week with Senator Simpson, he had gone down and visited with Ross Perot, and he said he still has all those charts, those flip charts that he went through on TV. You know, here's what the debt's going to do. Here's what the deficit's going to do. Here's what Social Security's going to do. And he had all the charts, and he nailed it. He has all those framed, and they're up in his office. I thought that was kind of interesting. So this was somewhat known early on by individuals, but it wasn't widely known, and it wasn't a big threat or scare. But now we have had Simpson Bowles, and people ask the question, why did that fail? That should have gone forward. That should have worked. Why do we have government shutdowns? I think it's a good thing that they just put forward a debt ceiling that goes through Obama's presidency into the next presidency. I think it's a bad thing to the capital markets. Every time we get to one of these debt ceilings, you wonder, are they going to vote to, increase it or not? The capital markets get a little scary. Everything kind of gets a little bit concerned. But all that concern, and every time that happens, creates political will to change and make a difference. So that's why I think the political will exist to do something before there's a Greece-like catastrophic event. But we'll see. Please.
So in comparison with other countries and other nations around the world, what are their debt compared to our debt, and how does that affect the world?
So the question was, compared to other countries around the world, what's our debt like compared to their debt? There's somebody Google it while I'm up here talking on their computer. You got Google there, dude? Google the sustainability index. I think it was Stanford, maybe Stanford Sustainability Index. The United States is something like 38th on that list, right in and around Greece. But he'll find it, and it's just not something on the top of my mind. But it's a really well-developed sustainability index of the federal governments around the world and their ability to be sustainable based on their debt structure, their tax policy, their receipt of income, and their expenditures. And once you find it, just wave or something. There was another question here.
Yeah, this is kind of more from a student perspective. With all the solutions and considerations of, helping reverse the debt, you said, informing Congress, informing the president to help implement those change. What, as accounting students or business students, can we do to be the person to implement those changes? Would we go for Congress, or would we try to, that makes sense?
What can we do as a student? Well, you students can go to the offices of every member of Congress has a local office in their district. As students, you should take this information, write it down, and say, hey, we learned this stuff at this program. Go to, I don't know who your member of Congress is and where their local in-district office is, but a group of students should pull this information together, outline it, and go sit down with the member, try to get an appointment with the member. You might meet with their staff and tell them, this is what we learned, we're concerned about it, what are you doing about it? That's one thing you can do that will feel like you're actually doing something, like very short term. Long term, what you can do is actually do consider running for some state, local, district type. Utah's doing great stuff with the state legislature trying to figure this out and how it's going to impact them. But that's how you can make a difference, is get involved. Fix the debt. I don't know if there's fix the debt representatives on campus in the student body, but you can get involved in that organization and have them come speak and hold events and talk about it. Those are a couple things as young, kind of up-and-coming professionals that you can do. I'm going to go back and forth, kind of. This dude has not taken a research class, obviously. Did you find it yet? U.S. government sustainability, something like that. I was gonna go here and then I'll come over here, please.
So you show the situation as it is now. Usually if something like that keeps on going, there comes some sort of breaking point where a country is forced either into inflation or shock therapy.
Yeah.
How far off do you think we're from that point, and what role do you see for inflation in this?
Yeah, so the point was, it's back to that point. When's the shock? What's the shock point? When's it gonna happen? When does it impact inflation? I wish I had a crystal ball. I'm just an accountant that can read this financial information and tell you we're in a world of hurt. Economists and others need to chime in on that, but I will tell you, I have a bill. I gave a presentation like this, and somebody in the audience presented me a gift, and I immediately became a trillionaire. I got $100 trillion bill from Zimbabwe that's worth about $4 in the United States. So that's what inflation is all about. At some point in time, inflation, and you guys are taking economics, and the economist professors are going to be way better at this than I am, but this is what inflation means to me. Inflation is, there's something that you want to buy, and there's more people that want to buy that than there are things to buy. And as a result, the price of it goes up because there's more demand than there is supply. That's what inflation is all about. At some point in time, interest rates rise, goods become expensive. If interest rates rise and we start crowding out our budget and goods become more expensive, we're in a real world of hurt. I think part of the reason, my belief is, part of the reason that we continue to see interest rates stay at near zero is because our country can't afford for them to get above zero. I think that interest rates will be increased. I think in this next, as long as there isn't a cratering of the stock market, the economy, if something doesn't happen, in the papers today, China's doing relatively well again based on the stimulus that's been done there. I think their stock market went up almost 2% yesterday. Unless we see something catastrophic happen, unemployment increases, something strange happens, if we don't, we're going to see a very small interest rate increase at the next Fed meeting, I think. It's not going to affect real interest at this level, but they're going to have to continue to increase interest rates over some period of time into the future, and they're going to have to do it at a real slow pace because the country can't afford it. I'll go. Okay, I'll come back. Tell me, give me a warning over there. Thank you. Did you find it? What'd you get?
It's an Excel sheet that I was able to download. It has the human well-being, environmental well-being, and economic well-being of 151 countries. Probably top 151.
That's not exactly it, but I'll find it and I'll give the information. I'll find it with somebody that has a computer, and then maybe you can mention it or something. But I'll find it for you. But we're down the list. I mean, the countries that are at the top of the list are like Australia, New Zealand. They're countries that generally have huge resources, whether it's copper, gold, mining. They have huge resources within the country that produce a lot of economic growth. And the same thing in our country. If you look at our country, the states that are in really good shape, Utah's in really good shape. Wyoming's in really good shape. There's certain states that are in really good shape that don't outspend for the individual person that lives within that state. But I saw a hand over here somewhere. Are we done with hands? One last hand. We got time for one last hand.
I was intrigued by your comment about the statements not being correct, modified opinion. If that were to happen in a public company, there would be fraud charges against the auditors.
So here's the deal with in a public company environment, you're not allowed to have a modified opinion. You can have a going concern opinion, but if a public company has a modified opinion, they're not allowed to do primary offerings. They can do secondary offerings. The secondary offering is when shares are being sold from shares that individuals own at the company. A primary offering is when shares are sold and the money comes to the company to spend. So public companies that have a modified audit opinion are not allowed to go to the public market and raise money. I think, and there's actually members of Congress, very conservative members of Congress, that think it would be a good idea to not allow the country to borrow money until it can produce a clean audit opinion on its financial statements. The problem is the Department of Defense will likely never be able to produce a clean audit opinion. It's just too difficult. There's too many assets that they have. They don't know exactly where they are, what they have, and it's going to take a long time to put financial reporting systems in place to allow certain departments to have a clean audit opinion. But they got to try to minimize those. They can kind of isolate it, right? But it's a good point. Thanks so much for having me. Have a great rest of the conference. Enjoy the day, and thanks for letting me spend some time in Utah.